Good morning. Today we are initiating coverage on the underlying data infrastructure sector, powering modern cloud applications and generative AI, with a specific focus on the leading enterprise search and vector database platforms. As institutional investors look past the semiconductor layer to find the software beneficiaries of the AI build-out, the critical bottleneck has become data retrieval. Large language models are essentially stateless without a robust backend to query proprietary enterprise data. This is where retrieval augmented generation, or RAG, enters the equation, heavily reliant on vector search infrastructure. Our proprietary analysis suggests this segment is significantly mispriced relative to its growth trajectory. We are initiating with an overweight rating, modeling a 24% cloud revenue compound annual growth rate from FY24 to FY27, and forecasting free cash flow margins to expand to 18% by FY26. The fundamental thesis is anchored on the platform's stickiness as core plumbing for both observability and next-generation AI deployments. Turning to market dynamics and TAM expansion, we view the total addressable market as a blend of three overlapping vectors: enterprise search, observability, and security analytics. Combined, our bottoms-up market sizing implies an $85 billion blended TAM by 2027. However, the true alpha generation lies within the vector database subsegment, which we project will grow at a 35% CAGR over the next 4 years, significantly outpacing broader IT spend. Currently, cloud migration represents roughly 60%. Assessing the structural moat requires a deep dive into the underlying architecture. We categorize the technological shift as the evolution from traditional lexical or keyword-based search to high-dimensional vector search. Relational databases are structurally ill-equipped to handle the unstructured data required for modern AI workloads. By natively integrating proprietary vector search capabilities, the platform achieves a 50% reduction in compute latency compared to bolted-on hyperscaler alternatives. This architectural superiority translates directly into pricing power and high switching costs. Our channel checks indicate gross retention rates consistently exceeding 97%. The economic reality is that migrating an enterprise's central observability and search nervous system is prohibitively disruptive. This native hybrid search capability, blending sparse and dense vectors, creates a formidable barrier to entry against both legacy relational incumbents and pure-play venture-backed vector startups, lacking enterprise-grade security and compliance scaffolding. Focusing on top-line composition and the ongoing cloud transition, the revenue mix shift towards SaaS is the primary structural growth engine. Cloud revenue run rate has now eclipsed the $1.2 billion threshold, providing high-margin, recurring visibility. While macroeconomic optimization cycles compressed consumption models over the past 4 quarters, our cohort analysis indicates net retention rates are stabilizing in the 110 to 112% range. Crucially, enterprise traction is accelerating upmarket. Customers contributing over $100,000 in annual recurring revenue grew by 14% year-over-year, demonstrating the platform's mission-critical nature despite tightened CIO budgets. Furthermore, remaining performance obligations, a leading indicator of future revenue realization, expanded by 22% year-over-year. This RPO growth provides a highly defensible downside cushion, underwriting our conviction in the sustainability of the top-line trajectory through the next fiscal cycle. Shifting our focus to the margin profile and operating leverage, management has successfully pivoted the operational framework from a growth-at-all-costs mandate to a disciplined Rule of 40 paradigm. Over the trailing 12 months, we have observed a non-GAAP operating margin expansion of 450 basis points year-over-year. The combined revenue growth and free cash flow margin metric is currently tracking at 38%, firmly on a trajectory to cross the Rule of 40 threshold by year-end. A critical component of our bullish margin thesis is the normalization of dilution. Stock-based compensation as a percentage of total revenue has declined structurally to 14%, down from historical highs. This operating discipline translates to tangible cash generation, with our models projecting a forward 12-month free cash flow yield of 3.5%, offering a compelling margin of safety relative to high-growth software peers. Moving to our valuation methodology, we employ a bifurcated valuation approach, heavily weighting enterprise value to next 12-month sales, alongside an enterprise value to unlevered free cash flow framework to capture the inflection in profitability. At current levels, the asset is trading at roughly 6.5 times EV to NTM revenue. This represents a substantial dislocation from its historical 5-year average multiple of 11.2 times. We assign a target multiple of 8.0 times on our FY26 revenue estimates, supported by stabilizing cloud consumption and accelerating AI-driven workloads. The fundamental disconnect here is the multiple compression occurring precisely as the free cash flow profile inflects positively. This divergence between standard EV to sales contraction and accelerating EV to FCF fundamentals presents a highly asymmetrical entry point for institutional capital allocating towards structural AI infrastructure. Prudent equity research demands a rigorous examination of the bear case scenario. Our downside model zeroes in on hyperscaler commoditization as the primary structural risk. Should AWS or Azure aggressively price their native open-source forks of the core search technology, we could witness acute pricing pressure on the cloud-managed service. In a macro-driven recessionary environment, continued IT budget optimization could compress net retention rates below the 105% threshold, severely impairing the underlying SaaS economics. Additionally, enterprise deployments of generative AI are facing prolonged sales cycles and internal governance hurdles, which could delay the realization of vector search revenues. Under these downside assumptions, modeling a terminal growth rate deceleration and multiple contraction to 4.5 times EV to sales, our bear case price target implies a 25% downside from current trading levels. Conversely, our bull case scenario models an aggressive re-rating driven by a faster-than-anticipated transition of enterprise generative AI projects from proof of concept to full-scale production. If the friction associated with retrieval-augmented generation deployments subsides, we project a rapid re-acceleration of net retention rates back above the 120% watermark. Furthermore, vendor consolidation initiatives by Fortune 500 chief information officers naturally favor comprehensive data platforms over fragmented point solutions, which we model to drive larger initial contract ACVs and multi-year commitments. In this accelerated growth environment, the market will inevitably reprice the equity to reflect its strategic scarcity value in the AI stack. Applying a 10 times EV to NTM revenue multiple on upwardly revised outer-year consensus estimates, our bull case assumes robust margin expansion and yields a price target reflecting over 70% upside. Analyzing relative valuation via our peer comps matrix. When benchmarked against the broader observability basket and next-generation database peers, such as MongoDB and Datadog, a distinct valuation gap emerges. The asset is currently trading at a roughly 30% discount to its next-gen database peer group on a growth-adjusted basis. Furthermore, the price-to-earnings growth, or PEG ratio, is structurally more attractive than the legacy observability incumbents, given the superior forward free cash flow growth algorithm. While Datadog commands a premium multiple north of 14 times EV to sales based on best-in-class retention, our target asset provides a highly correlated macro exposure profile at a dramatically lower baseline valuation. We view this relative discount as unwarranted, given the comparable gross margin profiles and the explicit vector search optionality that legacy relational databases inherently lack. In conclusion, synthesizing our discounted cash flow models and relative multiple analysis, we derive a 12-month base case price target that implies a 22% upside from current levels. The catalyst path over the next 2 quarters is heavily indexed to leading indicators of cloud consumption and early production-level data from newly launched vector-native serverless offerings. Given the structural necessity of data retrieval infrastructure in the ongoing AI supercycle, combined with management's demonstrated operating leverage, the fundamental risk-reward asymmetry is highly compelling at current EV to FCF levels. We view any near-term macro-induced volatility as an accumulation opportunity for growth-oriented portfolios. We reiterate our overweight rating and designate this platform as a core institutional holding for structural exposure to the data layer of the artificial intelligence economy.